The biggest names in the auto industry are being hammered today because they're finally being forced to tell the truth. First, the economy never recovered, and second, it's falling off sharply again. That means they're going to be selling fewer cars, inventories are soaring, production will have to be cut, and workers are going to have to take the hit. Stellantis reported dismal results. Its stock is down 12%. The thing is, it was trading at a record high as recently as March. Since then, the economy has tanked, taking its shares with it, falling more than 50% over these last 6 increasingly global recession months. Even the high-end market has taken a major beating. Aston Martin saw its stock drop 22% just today, as the company's new CEO says there's no way they're going to meet turnaround targets that were given just a few months ago in July. Instead, the company has trimmed its sale forecast by 1,000 cars, which is an enormous revision to projection for Aston Martin. Volkswagen. This weekend, it issued its second profit warning in just 3 months. The global car market is rapidly falling off and coming to grips with this reality. In fact, the company's CFO said the market is simply no longer there. Stellantis cited a, quote, deterioration in the global industry backdrop and then warned about big and growing problems in North America. Aston Martin is seeing major setbacks in China and Asia. Volkswagen said the market in Europe is falling off and never coming back. We've also got recent data around the world which shows it's more than just these recent car maker warnings. The problem is becoming more widespread, and as these companies are saying, it's getting deeper quickly. For a little while, automakers sold fewer cars, but got a ton more revenue for each one. That's all done now. The global economy has to normalize not to where prices went, but to where volumes are. And not just today, where they're going to be tomorrow and beyond. And the difference between those two levels, that's the workforce. You can hang on to workers when revenues are rising for non-economic reasons, even if you aren't using them as much as you should. Take away those rising revenues as the global recession is doing, and suddenly corporate managers have to take a second look at their factories, at their payrolls, at everything. And that's just what we're hearing from the auto sector. And it's not just one place or another. It's not just in Europe. As Stellantis said this morning, it's about North America too. According to its statement, the company today revised its 2024 financial guidance, reflecting decisions to significantly enlarge remediation actions on North American performance issues, as well as deterioration in global industry dynamics. And so they're going to they promise to keep their inventory level at just 330,000 units, moving that inventory cap up to the fourth quarter of this year, rather than hoping to hit it in the first quarter of next year, because that's how much sales have fallen off. And they're also going to be cutting back on North American shipments by 200,000 units for this year, rather than just 100,000 they had previously planned. And in order to even have a prayer of hitting even these targets, the company also announced that it was going to raise incentives even further, meaning they're going to be cutting prices more just to be able to keep it from deteriorating faster and farther than it already has. No wonder the stock was getting hammered. The company's basically saying that the projections that we had just a few months ago, throw those out the window. Things have changed that quickly. So as demand continues to fall off, there's going to be this continued vicious cycle of lowering prices, lowering production, lowering work, lowering workers, which leads to the same thing, and on and on and on we go, especially since the automotive business has been one of the few key sources of counter-cyclical strength over the last couple of years. Take that away, and the economy gets a whole bunch weaker, a whole bunch quicker. As it is, the company says it now projects free cash flow in the range of negative 5 billion euros, or about $5.6 billion, to negative 10 billion euros, which was a huge change because they previously guided for positive cash flow. Now, all of a sudden, with all these production hits and the incentives and the inventory caps, the company's fortunes have gone downhill rapidly. So what does that say about the rest of the economy, as well as what is that going to do to not just Stellantis, but other car makers in a similar situation? They have to cut costs. There's a plunge and a transformation ongoing at the high end of the market, too. It's not just the big name retail car makers. Aston Martin reported results today and really guidance today that suggests nothing good going on there, especially focused on China and Asia. Back in July, the company said it was expecting sales to improve and even accelerate in the second half of this year, which would result in, quote, significant year-over-year growth in core profit. That was just a couple months ago. And then today, the company says it has been clear that we need to take decisive action to adjust our production volumes for 2024, given a combination of supplier disruption, the weak macroeconomic environment in China, and a proactive decision to strategically align our production plans to optimize efficiency and to achieve a more balanced delivery cadence in the future, at least according to the new CEO, Adrian Hallmark. As a result, management now says it's going to sell 1,000 fewer cars than expected, and that's just the remainder of 2024. So that caused a 25% crash in the stock price that, the stock came back a little bit and finished down about 22%, but still a huge decline in the stock price because 1,000 fewer cars for Aston Martin is a huge deal. They had seen their sales absolutely soar, especially to China, back in 2021 and 2022, when it looked like the pandemic recovery was an actual recovery. It was all just a price solution, especially in China. As we know now, the Chinese economy just continues to get worse and worse and worse. In fact, that's what Beijing finally admitted with their quote-unquote bazooka stimulus announced last week, both monetary as well as fiscal. And so Aston Martin is saying, yeah, we're seeing the same results that now the Chinese authorities are, which is that the economy is in big trouble. According to the company's latest projections, the Asia-Pacific region accounted for more than a fifth of their sales last year. So a slowdown in China, in Asia more generally, it's a big impact on Aston Martin. So it's not just Europe, it's not just North America, it's not just retail level autos. We're also talking about high-end autos as well. The whole economy is an illusion. And that's just what we've been tracking in our reading of financial signs and signals from the Eurodollar system. And right now, it's our fall sale at Eurodollar University. So if you are interested in becoming a Eurodollar University member, we've got tons of content focused on tearing open the black hole Eurodollar system and understanding these mechanics. We've got basics videos on what is money, what are curves. I've just published the latest one on interest rate swaps. Special presentations that talk all about the history, the fundamentals, and even the future. And all of it is discounted as part of our fall sale. We've also got big savings on subscriptions for the daily briefing, as well as the absolutely essential deep dive analysis. And you can find information on what each of those offers, as well as the details about the fall sale at our website, eurodollar.university. On to Volkswagen, Germany's big producer, Europe's huge car maker. I already talked about them about a month ago when they announced plans to close factories in Germany for the first time in their history. And the reason was they're just not selling near enough cars. So this weekend, the company announced another major profit warning, the second one over the last 3 months. In their statement from September 27th, they said, in light of a challenging market environment and developments that have fallen short of original expectations, the company now expects deliveries to customers to be around 9 million vehicles when they sold 9.24 million last year. And Volkswagen now expects group sales to be around 320 billion euros compared to 322.3 billion previously forecast. So they keep cutting projection, they keep cutting sales. Why? Well, according to one news outlet, Volkswagen said European car sales would not return to the 16 million sold across the market in 2019 before the pandemic disturbed global supply chains and semiconductor chip shortages in particular slowed car production. Here's the thing. The market in Europe has recovered since then, but will not return to its former level. This is according to CFO Arno Antlitz. We expect around 14 million vehicles to be sold per year in the future, if at all. And that has nothing to do with our products or poor sales performance. The market is simply no longer there. From 16 million down to 14 million as a whole market. Again, the economy never actually recovered. It just seemed that way because of the price illusion. And Volkswagen isn't just suffering for it, it's actually being the best example of it. And also, as we move forward and as they close factories and lay off workers, The best example, unfortunately, of what we should expect as this process continues to play out. They've already talked about shutting down factories. In fact, I talked about it in a previous video. There were rumors that the job losses would hit about 30,000, which the company denied it would be that much. But they're negotiating now because there are going to be job losses. There are going to be facility closures and things like that that are going to take place. And it's not just Volkswagen. As Bloomberg reported earlier today, all three major German car makers, Volkswagen, Mercedes-Benz Group, and BMW, have now warned about their profit this month. The slump in China and rising competition from EV makers, including Tesla, are forcing car makers to discount, crimping margins. But here's the thing that they always bury at the end. Declining consumer confidence is sapping demand for combustion engine cars, or basically their bread and butter. And it's not just consumer confidence that's declining, as I talked about in my last couple of videos. We keep going over this all the time because it's that important. Consumer confidence isn't necessarily about consumer spending. Consumer confidence is first a reflection of the labor market dynamics. So as the labor market in Europe, in the United States, in China gets weaker and weaker, we see that show up in consumer confidence, and then consumer confidence shows up as things like falling auto sales, and as we move further along in this process, just sales in general. That's what companies have been warning about over the last 6 months. And over the last 6 months, more and more we've heard from car makers, which, as I said, was a huge deal because the auto business had been the one key source of strength in this goods economy contraction that goes back to 2022. Had been one of the key sources of strength, because we've got not just these corporate warnings from Stellantis and Aston Martin and Volkswagen covering basically the entire planet, as well as all different car segments. We've also got a ton of data that shows us the same thing. While European car sales have fallen off, it seems like on a permanent basis, the same is true of the United States. The U.S. economy has been similarly impoverished, even though, again, the price illusion had covered up this absolutely incredible decline over the last several years. According to the Bureau of Economic Analysis, it's the same outfit that puts together the GDP figures. What you see in unit sales, or estimated unit sales for U.S. lightweight vehicles, trucks and cars and things like that, sales were rising and rebounding through up until around April of 2023, as the auto industry was getting back to normal, fixing all the supply shocks, finally getting some semiconductor chips into these vehicles. And what happened in March and April of 2023? That was the banking crisis. And it wasn't just the banking crisis, there was also the credit crunch that happened afterwards. So softening sales, or at least in this case, plateauing sales, back around that time makes good sense. It wasn't rate hikes, it wasn't the Fed, it was the conditions in the credit market as well as in the labor market. Because what happened starting in May of 2023? That's when the unemployment rate began to go up, and unemployment itself started on its current trajectory. So as unemployment rises, bank credit becomes more difficult, car sales start to fall short of where they were supposed to go. Many people were expecting, many car makers were expecting, that they would go back to where they had been in the pre-pandemic period. But just like in Europe, what we see is that they've leveled off far short of that level. And over the last year or so, especially in 2024, car sales have now starting to decline again. So not only do you have the U.S. car market that's not going back to where it was in the pre-pandemic period, you now have prices that are going down. As Stellantis said, we have to cut prices, and they're not the only ones. Look at the U.S. CPI for new vehicles. That has been declining all year as well, though it increased a little bit in August. Car prices are coming down because weakness in sales. Sales are not going back to where they were in the pre-pandemic period, and they're now falling off yet again. It's a very toxic mix, and not just for the auto industry. That's just another industry, one of the last ones left to finally succumb to the downside of the supply shock. And as sales are pulling back, that means inventories are rising. Those have absolutely soared. So dealers are slowing down the amount of stock they're bringing onto their dealer lots, which is causing wholesale inventories to absolutely skyrocket, which means as wholesalers see more inventory skyrocketing and getting stuck with more product that they're not selling to retailers, they're telling producers and manufacturers, we can't sell this stock. You need to either cut the prices or stop sending us as much, which is what automakers are now saying more and more, and saying more and more forcefully as well. And you look at the inventory to sales ratio on the wholesale level, and this is just the United States, it had been up around 1.75, which is the high end of the range for the last couple decades. That was in February. Starting in March, the inventory to sales ratio has risen to, as of July, which is the latest estimate that we have, 1.89, which is clearly and solidly in recession territory. It's equivalent to October 2008 and pretty much nothing outside of 2008, 2009, or 2020. So wholesale inventories are already at an alarming level, and that just means that there's going to be more setbacks yet to come. So Stellantis cites big problems in North America, selling fewer cars, rising inventories, having to cut costs. Aston Martin says we're having huge problems in China and Asia. We're not going to sell near enough cars that we need to. Volkswagen says Europe, we have a huge problem going on in Europe. And basically what you see is that the issue is not just Europe. It's not just the US. It's not just China. It's everywhere. Globally synchronized weakness is finally caught up with cars and autos. And the data that we have backs up these warnings. We see car sales in the US, for example. They have slumped to lower levels than the pre-pandemic. And not only have they plateaued, they are now falling off, especially as the price illusion recedes. We see the same thing in Europe. And with inventory starting to go up, that can only mean worse yet to come. On the one hand, that's good, like everything else associated with disinflation. Disinflation sounds good. And disinflation, given how fast and how far car prices went earlier in this decade, disinflation sounds terrific. But the reason why there's going to be disinflation and the consequences of that disinflation make it a highly net negative. This isn't just about global recession prospects or a setback in the auto industry. It's about what the auto industry is showing us as far as that global recession being part of the process of the downside of the supply shock, but normalization after the last several years of huge artificiality and the price illusion. You don't normalize to where prices went, you normalize to where fundamentals are. And that's what the auto industry is showing us, that the fundamentals that we have to get back to are a lot lower than people think. So while a global recession is one thing, it's one thing in the bigger picture that points to much bigger trouble in the economy and much bigger trouble for workers. Stellantis actually mentioned uncertainty over the presidential election as an excuse for its increasingly grim results. Steve and I just talked about this presidential election uncertainty stuff in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. If you want to become one, check out our fall sale. And until next time, take care.